As producer and consumer prices fall, is inflation finally in the rearview mirror? Hello, this is Robert Romano, Executive Director with Americans for Limited Government and Americans for Limited Government Foundation. Hit that subscribe button. Today, we're going to be talking about the latest inflation numbers. Both consumer and producer prices are down for the month of March. And prices have been slowing for actually a couple years now. And so this is really just continuing a long-term trend that I've been, we can all see forming following peak inflation that we saw way back in 2022. Inflation slowed down, but it never really caught up with incomes, and certainly not in enough time to be of any help to former President Joe Biden and former Vice President Kamala Harris, who, Biden dropped out of the election, and then Harris lost the election to now President Donald Trump, who, when you have inflation like that, the opposition party, in that case in 2024, it was the Republicans, can benefit politically, and threw the Democrats out, and Republicans won the trifecta: the House, the Senate, and the White House. And so first I wanted to let you hear from President Trump himself reacting to this. I think that, again, it's very good news for the American people. Here is President Trump.
Thank you very much. We had a very good meeting. We're talking about a lot of different things. Consumer prices have actually dropped. There's very little inflation. Everybody predicted a lot of inflation, very little inflation. Energy costs are down. Interest rates are probably down. They scatter, but they're probably down. Prescription drug prices are even to down. We're doing very well. It's been amazing. We had a big day yesterday. There'll always be transition difficulty, but we had in history, it was the biggest day in history, the markets. So we're very, very happy with the way the country's running. We're trying to get the world to treat us fairly. This is something that should have been done 25 years ago, and it wasn't. Should have been done 40 years ago, and it wasn't. But no president was willing to take it on, but you had to. It's not sustainable. It wasn't sustainable. And as you know, without a lot of money being added, this is a lot of money that we could add, the country is making approximately $2 billion a day. And when you think of it, we've never done that before, never come close to it. And the number is probably $3.5 billion a day. And that makes us a very strong country. But we have Scott here and Howard and some of the people that are working on deals. And the biggest problem they have is they don't have enough time in the day. Everybody wants to come and make a deal. And we're working with a lot of different countries. And it's all going to work out very well. I think it's going to work out really very well. But we're in good shape. There's no inflation. There's very little inflation. And I went 4 years without inflation, and I tariffed. I took in hundreds of billions of dollars from China and others, taxes in China. But we took in hundreds of billions of dollars a year from China, and we had no inflation, essentially. So we think we're in very good shape. We think we're doing very well. Again, there'll be a transition cost and transition problems, but in the end, it's going to be a beautiful thing. We're doing again what we should have.
Need a confidence boost when filing your own taxes? Add it to File Online with H&R.
Done many years ago. We let it get out of control, and we allowed some countries to get very big and very rich at our expense, and can't let that happen. It's not a sustainable formula. So I wanted to just thank everybody at the table, and maybe I'll go around and ask.
So that was President Trump reacting to both the inflation numbers and also some of the movements that we've been seeing in markets, and noting the fact that, during his first administration, there were tariffs and actually very low inflation. And I'm going to go over my piece today: as producer and consumer prices fall, is inflation finally in the rearview mirror? And we're going to look at today's producer price index news release that came out that showed that it was down. Final demand prices, they were only up 0.1%. I'm sorry, decreased 0.4% in March. That was following 0.1% increase and a 0.6% increase in January. So final demand for producer prices down 0.4% in March. And that includes, kind of everything across the board here. You see total down 0.9 for final demand goods, foods down 2.1%, energy down 4%, overall total final demand down 0.4%. Other things that were down, let's see here, trade down 0.7%. Transportation and warehousing down 0.6%. This is producer prices. This will eventually find its way into consumer prices. And that was yesterday's release, actually, where consumer prices decreased by 0.1% in March. That was following a 0.2% rise in February. But when you see it go down for even a single month, that's actually highly significant. That usually does not happen. Usually inflation is going to go up at a fairly consistent clip. So when you see it dropping down like this, you can, you notice it. So let's see how that stacked up. Much of it's coming from energy being down 2.4%, energy commodities 6.1%, including gasoline down 6.3%, fuel oil down 4.2%. Commodities less food and energy was down 0.1%. That included a 0.7% drop in used cars and trucks, and also a 1.1% drop in medical care commodities, and a 1.4% drop in transportation services. So all that stacks up to inflation is dropping, both on the consumer side and on the producer side as well. And I say this is really not much of a surprise. If you've been following this broadcast, we've been going over how commodities prices have actually been dropping as of late. But again, producer prices dropped 0.4%, consumer prices dropped 0.1%, according to the latest data from the Bureau of Labor Statistics, amid continued drops in food and energy prices, particularly on the producer side, which saw 2.1% drop in food prices and 4% drop in energy prices, respectively, again, on the producer side. These price drops came prior to President Donald Trump's April announcements of reciprocal tariffs, which are now paused for 90 days, but also 10% tariffs globally, which are now in effect, but except for China, which is actually at 145% tariff rate right now. Since then, there have been further drops in commodity prices, including oil, that factor into producer prices. So we look at light sweet crude here. It's currently at $61.45. It was at $72 a barrel. When I wrote this, it was $60, but you have a little recovery today. So it's about a 15% drop, all of which means inflation is falling and appears to be poised to continue falling. Again, so the prices that we're seeing in March, they're taking about mid-month. So we're going to see, I think, even further drops in April off of these commodities drops, which is food, energy, metals, and things like that. In spite of repeated predictions by opponents of President Donald Trump's tariffs of both parties that prices would rise in response to his tariffs on Canada, Mexico, China, and the rest of the world. We can see here's an op-ed from Rand Paul on his website, paul.senate.gov, where he's predicting, price increases that are going to come from tariffs. And he agrees with Senate Democrat leader Chuck Schumer, who says the same thing. It's going to be higher costs for American families, except we're not seeing it in the data. Trump's been announcing tariffs. Prices are down in March, and for consumers and for producers are down in March. And off of the commodities prices, I think you would expect to see prices go down again in April as well. But we'll see. It simply has not happened yet, though. The price increases with consumer inflation the past 12 months now 2.4%. and producer inflation at 2.7%. That's coming off of peak inflation in June of 2022 of 9.1% for consumers and 11.3% for producers. And so you can see, you can go back into the archives and see that consumer prices in June of 2022, when Joe Biden was in office, were 9.1% and at the peak, and 11.3% for producers. And now it's all the way down to 2.4% and 2.7% respectively. And it's really not that surprising. When you look at the money supply, for example, has not increased at all since 2022. It's currently at 21.67 trillion. Well, in March of 2022, it was at 21.7 trillion. So we haven't seen an increase in the money supply, for 3 years now. So that's pretty significant. So you would, if you're going to talk about inflation, you would expect the money supply to be increasing, but it hasn't been. And that, a lot of that has to do with higher interest rates and soaking up all of the excess dollars. This about $7 trillion was printed for COVID. And then the Fed tapped on the brakes in 2022, and the money supply has been kind of frozen. It went down a little and then went up a little, but it's flat from where it was 3 years ago. So that's not surprising to see inflation cooling off when you have high interest rates and the money supply is not increasing. Also, energy production, including oil, has been rising. This is crude oil production, thousands of barrels a day. So we're in 2019, it was at about 12.8 million barrels per day prior to COVID, 12.9 billion. And today in October, November, January is at 13.1 million barrels per day, U.S. field production of crude oil. So you've seen a decrease in oil production in 2020 during the middle of the lockdowns and during the first year of the Biden administration. But then it starts rising, particularly following Russia's invasion of Ukraine. And even the Biden administration had to admit that it really needed to increase oil production. By then, even prior to Russia's invasion of Ukraine, consumer inflation had already tapped out at 7.5% in January of 2022. And all the while, the Federal Reserve left interest rates at 0%. They waited until after Russia invaded Ukraine, and then prices were rising even faster. And they said, maybe we should start hiking interest rates to deal with this inflation problem. And by then, they were really late, I think, to the game in terms of addressing inflation. And then oil production was very slow to follow up, too. So you had a global supply glut following COVID that really did not catch up until 2022, 2023. And only then did prices finally begin not falling, but just to slow down the growth of it. So that it's, again, not surprising now to see oil production rising, to see with the money supply being flat, that you're seeing an overall drop in consumer prices and producer prices. Demand has also cooled as American households maxed out their credit. Total consumer credit owned and securitized has actually declined by 1% the past 12 months. And here you can see total consumer credit owned and securitized. It tends to slow down or even fall, usually following recessions. That seems to be about the time that you would normally see drops. There's been no drops in consumer credit owned and securitized that did not coincide or follow a recession. Trying to look at the actual drops here, in the late 50s, you had a drop by 1958 that followed a recession. In 1975, you see a drop in consumer credit, and that followed a recession. Let's see here. In 1991, you see a drop in consumer credit that followed a recession. In 2009 and 2010, you see a drop in consumer credit that followed a recession. You see it also very briefly in 2021, a drop in consumer credit that followed the COVID recession. And here we are again with consumer credit dropping. Well, if this wasn't coinciding with a recession that had already happened, maybe it's already happened and it just hasn't been booked yet. Maybe we're currently in one and it just hasn't been booked yet. Or maybe there's one on the horizon, which obviously hasn't been booked yet. But if we're not having a recession coming off of this peak inflation and with consumer credit dropping, it would be the first time that consumer credit has actually decreased on an annual basis that didn't coincide with a recession. So my bet is that actually that probably means we're having a recession, probably right now, if you ask me. Additionally, unemployment has already risen by more than 1 million before President Trump was even sworn into office. This is another thing that makes me think that the Biden era inflation probably caused a recession, because you're seeing now unemployment is 7.08 million, while during the following COVID, the low was about, let's see here, January of 2023 at 5.74 million. Well, now you're up to 7 million. So maybe the inflation overheated the economy, people maxed out their credit cards, and then unemployment jumped up by 1 million. And then Joe Biden and Kamala Harris lost the White House and the Senate. Republicans picked up the Senate and the White House because the economy sucked. And this, therefore, whatever recession there is, was probably many, many years in the making. That's my hypothesis. I was talking about it all throughout 2024. Now, arguably, unemployment has not moved too much, because the unemployment rate is only 4.2% right now, which is historically considered low because of ongoing labor shortages with the ongoing baby boomer retirement wave, with more than 900,000 Americans over the age of 65 leaving the labor force every year and accelerating. This is not in labor force, no disability, 65 years and older, from the Bureau of Labor Statistics. And you can see that in the Great Recession, the financial crisis, there were 18.9 million Americans who were over the age of 65 and not in the labor force, ergo retired. Well, now that's up to 33.2 million as of March of 2025. And that's a substantial increase. Almost 1 million people a year are retiring, and that's been leading to labor shortages, and that's going to keep the unemployment rate, in my opinion, rather low, relatively low, lower than it would have been, considering a potential recession. So if we have a recession, right now unemployment's only up by 1 million or so, about 1.3 million. And most of that was during the Biden administration. So whatever's going on with the economy has been many years in the making. Now, short-term market movements notwithstanding, the dollar has nominally strengthened 3.9% in the past 12 months. And so a strong dollar usually accompanies commodities prices and producer prices taking a hit, which they have. We've spoken about this before as well. When you look at the value of the dollar, the blue line is the nominal broad dollar index. The red line are producer prices by commodity, all commodities. And you see that the dollar has been strengthening. And we see now that producer prices are actually starting to fall, on a monthly basis, not on an annual basis, but even slowing down. You can see that when producer prices do go down, it's when you have a strong dollar. So, seeing the strong dollar, seeing producer prices slow down, again, none of this is surprising. And, the producer prices are taking a hit. You have a strong dollar right now, relative to a year ago, that you would expect to see that. Interest rates overall are also down since January, with 10-year treasuries moving from 4.8% down to about 4.5%. Two-year treasuries are down from 4.4% in January to about 3.9% now. And we can see that here. Here's the current 10-year treasury. This is live, so 4.48%, moved down a little bit since I wrote the piece. And here's a two-year treasury, maybe one up slightly since I wrote the piece this morning. But still, you're still down for the year on interest rates, which you would expect to see with inflation slowing down to a crawl here. That as inflation goes down, you're going to expect to see interest rates go down as well. Now, gold, after initially dropping, we could pull up gold here. We'll pull that up in just a second here. After initially dropping after the April 2 announcement, has been rising, showing signs of being a safe haven as it did in 2009 and also in 2020 and 2021. Here's Historical gold. Let's see here. We'll zoom out a little bit. All right, you can see there's gold. You can see during the 2000s, it was rising, 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 rising. Here's the financial crisis. You see a little bit of deflation during 2008, 2009, but that doesn't stop gold from rising, rising, rising as a safe haven, even as interest rates were dropping into 2008, 2009, 2010. Interest rates are down, way down, because the Fed goes to 0% interest rates. But so treasuries are a safe haven, but so is gold. And you're seeing, you see a slight drop there on gold right after following Trump's tariff announcement, but now it's up to like $3,300. So gold is once again a safe haven asset, as are treasuries. That's my argument. You're going to see the dollar strengthen from, eventually, as the Fed starts cutting rates and buying more bonds and things like that. These are, if anything, I argue, gold going up, treasury interest rates going down, the strong dollar, euro, over the past year, people leaving the labor force, unemployment going up, total credit owned and securitized going down, producer prices dropping, and consumer prices dropping. These are, if anything, recession signals historically, years in the making, that tend to happen at the end of economic cycles following peak inflation. As it is, the effective federal funds rate set by the Federal Reserve is currently at 4.3% and has been above consumer inflation at 2.4% for about 2 years now. Here is the federal funds rate. This is the Federal Reserve set interest rate that they lend to banks with, and banks lend to themselves with. But it's the federal funds effective rate. And you can see that the blue line is the federal funds effective rate and the consumer price index. So when inflation gets really high, the Fed will jack up interest rates to soak up excess dollars and then beat inflation down. You see, from about 1981 or 1980 onward, the federal funds effective rate was above that of the consumer inflation rate. So whether inflation is going up or down, if it's going down, the Fed would lower the rates. If the inflation started to go up again, the Fed would raise the rate, and there would usually be a spread between the federal funds effective rate, the interest rates, and that of inflation. So you bring interest rates above that of inflation, and then it helps to push inflation down. It's a very crude measure. If you bought a house in the 1980s, you had astronomical interest rates, and you had close to 20% interest rates in 1981. That's where Reagan and Volcker took it to try to slay inflation. And it worked. You saw inflation go from a peak of 14.5% in 1980 all the way down to 2.45% in 1983. But there was also a big recession as inflation was dropping. So when you can note here that when you see inflation dropping off of peak, you have a recession every single time. Pretty much, you see inflation drop. It's either happening during a recession or shortly following a recession. It's pretty much like clockwork. Happens over and over again. And so here we come all the way to 2022. You get peak inflation of 9.1% in June of 2022. And now peak inflation is way down. What the consumer, the federal funds effective rate is above that of inflation. Once again, where it should be, in my argument. We were arguing in 2021 and 2022. What the heck are you doing? Federal Reserve, inflation's getting out of control. Why aren't you raising interest rates? And they wait until after it's already 7.5%, after Russia invades Ukraine, and then prices go even higher. Then they finally start hiking interest rates. Too late, if you ask me. Look at that huge gap where consumer inflation was rapidly outpacing the interest rates that the Fed was offering at the time. And, they had gone to 0% during COVID because of, deflation fears. You saw oil briefly go below $0 during the middle of the lockdowns. And they left interest rates very low. While production was kind of on its back, and then you had printed $7 trillion all told for COVID, following COVID, that then brought prices up to the moon, and they didn't raise interest rates fast enough to compensate for it. But now inflation is going down with the interest rates as high as they are right now. If inflation continues falling and unemployment continues rising, one should expect the Fed to begin ratcheting down interest rates like they do every time those two things happen at the end of the economic cycle. So going back to the chart here, you will see that when inflation is coming down, the Fed will indeed cut interest rates. So it's not a question of if, but when is the Fed going to start cutting interest rates? Back in September, I believe we saw a partial, drop in the federal funds rate. I think they're going to keep on cutting interest rates. It could be we're already in a recession or are in one. Or it hasn't been booked yet, or that there is still one on the horizon. Generally, rising unemployment along with collapsing consumer credit is what usually happens as inflation slows down along with demand after the economy overheats, as it did in 2022. Politically, inflation has been slowing, but it just didn't slow down fast enough to help Joe Biden and Kamala Harris in 2024, who had to run on a record of inflation outpacing incomes. So if you have your druthers and you can choose between a recession or inflation, most presidents, I think, would prefer a recession. Richard Nixon had a recession early in his first term, in his first year. Ronald Reagan had a recession in his first year in office. George W. Bush had a recession his first year in office. And Barack Obama had a recession his first year in office. And all four of them got reelected pretty easily because by the time they were running for reelection, the economy had already begun recovering. And so you see, it's better to have a recession, if you're going to have one, very early in the administration. But if you see inflation outpacing incomes, well, we can just ask Gerald Ford what happens, what Jimmy Carter what happens. We can ask George Herbert Walker Bush what happens. We can ask Joe Biden what happens when inflation outpaces incomes, which is you're going to have one-term presidents. Again, Gerald Ford, Jimmy Carter, George Herbert Walker Bush, and Joe Biden were all one-term presidents because inflation outpaced incomes. So if you have your druthers and it's like, I'd rather see, if I'm Donald Trump right now, I'd rather see prices falling, even if that means we're going to have a recession. Get inflation on its back, kill the inflation, because otherwise, Trump's not going to run for re-election, but J.D. Vance might want to run for president in 2028. And if there's an inflation problem, it seems, especially if inflation is outpacing incomes, that seems to be the key metric. Are you better off than you were 4 years ago? Well, financially in 2024, objectively, you were not better off. Your purchasing power was down in 2024, and it was probably down in 1992. It was probably down in 1980, and it was probably down in 1976. And there you have one-term presidents. Otherwise, when you have a good, strong economy, even coming out of a recession that occurs early in an administration, those presidents tend to get reelected. Richard Nixon, Ronald Reagan, George W. Bush, and Barack Obama. They were reelected relatively easily, and that's the big difference. It's inflation. You don't want to see inflation running especially faster than incomes while you're president. As for the short-term gyrations of U.S. bonds, with rates rising right now at the same time stocks are selling, that's a worrisome sign. Usually you see a flight to safety into bonds when equities are selling off. So temporarily, we've been seeing interest rates actually rise following the Trump announcement for tariffs. So you can see here, prior to the tariffs being announced, Trump, say the end of March, was at 4.36%, the 10-year. Now it's up to 4.49%. This is a kind of a small move here. Let's go to the one-year chart on 2-year treasuries. You can see prior to March 31st, 3.9%. Now it's 3.95%. It did drop initially. There was a flight to safety, but then it started to go up a little bit. So this is a little curious. Lots of commentary in financial news publications right now about the interest rates temporarily rising as stocks are selling. What's going on there? our interest rates on U.S. bonds rising and the dollar weakening. When you see bonds selling, that means that U.S. dollar denominated assets are selling. Usually means the dollar is weakening short term because of inflation. Well, let's look overseas. For example, since April 2nd, the Japanese yen to the dollar has appreciated 6%, and the Japanese 10-year treasuries have been dropping following Trump's tariff announcement. So here's overseas. Here's the yen to the dollar, and you can see very clearly the yen has appreciated following Trump's tariff announcement. And we can also see that the Japanese 10-year treasury has actually dropped following the announcement. So there's a little bit of a flight to safety domestically. In Japan, you're seeing interest rates fall. That means that inflation expectations are falling in Japan. Here's another example where we can see the euro has appreciated against the dollar following Trump's tariff announcement. And we can also see that the German 10-year bond has also fallen from about 2.75% down to 2.55%. So you're seeing a flight to safety and a drop of inflation expectations following Trump's tariff announcement in Germany and in Japan. And we're seeing the yen is appreciating against the dollar and the euro is appreciating against the dollar. Well, that's going to make the dollar weaken. When people are selling dollars and buying euros, and they're selling treasuries and they're buying German bonds and Japanese treasuries, well, that could explain it. You could see that these economies are taking a hit. Japan's taking a hit. Europe's taking a hit from the tariffs. So maybe they're seeing a recession on the way too. Certainly growth expectations are lower. And so interest rates are falling. So therefore inflation expectations are falling. So you can almost discount the fact that interest rates are slightly up following Trump's interest rate announcement. The fact is that they're actually down for the year so far, for the 10-year as well as for the 2-year. So you see a drop in inflation expectations in 2025 so far, in spite of the tariffs. I'm not certain that the tariffs are inflationary, although Rand Paul seems to think so. Chuck Schumer seems to think so. But the Bureau of Labor Statistics says, nope, Trump's been doing tariffs. He started out with Canada and Mexico and China before April 2nd. And in March, we see prices actually go down for producer prices as well as for consumer prices. So maybe tariffs are not inflationary. Maybe inflation, as Milton Friedman taught us, is always a monetary phenomenon, has to do with the supply of money. And we can see that the money supply has not risen for 3 years. So that seems, the last time the money supply was rising, from its previous high was in 2022 when we printed $7 trillion for COVID. Well, we haven't printed any dollars since then with the high interest rates. So maybe if the money supply is not increasing and otherwise the production of things like energy are increasing and have been increasing since 2022, maybe we should expect to see interest rates going down or inflation going down, etc. Generally, lower interest rates abroad indicate lower inflation expectations overseas, not higher. It also indicates lower growth expectations. And then finally, domestically, as of April 9th, the Atlanta Federal Reserve is projecting that the U.S. gross domestic product will decline in the first quarter by an annualized 2.4%. Here's the Atlanta Fed, negative 2.4% as of April 9. The GDP Now model for real GDP growth in the first quarter is negative 2.4% on April 9, up from negative 2.8% on April 3rd. The alternative forecast model, which adjusts for imports and exports of gold, as described here, is negative 0.3%. And they say after releases from the U.S. Census Bureau and the U.S. Bureau of Labor Statistics, both the standard models and the alternative models forecast of first quarter real final sales to private domestic purchasers growth increased from 1.4% to 2%. But you can see here they're saying that GDP will probably go down in the first quarter by about 2.4%. And they've been saying that for quite a while now. It started out in January and February, they thought that GDP was going to go up. But starting at the end of February, the Atlanta Fed has consistently been saying, first on February 28th, that GDP would go down by 1.5%. And then it peaks on April 2nd or April 1st, rather, at negative 3.7%. And currently it's at negative 2.4%. And this is based on all of the data that's been coming in. So the inflation is down, GDP down, and this is years in the making because you're seeing, inflation has been slowing down, for 3 years now, as a matter of fact. And so when you see inflation slowing down, for 3 years in a row, eventually you should expect to see a recession that's going to follow that. Every other time we had peak inflation, it was either during a recession or a recession happened sometime thereafter. So maybe that's what we're getting here. The economy finally overheated. People maxed out their credit cards. And here you see consumer credit declining, so that tends to coincide with recessions. It's years in the making. So then you're going to eventually see it show up in the Atlanta Fed saying that the economy is going to go down. Well, it's about time. I've been saying this for years, and unemployment's been already up 1 million people. More unemployed are said to be unemployed in the household survey. And that was before Donald Trump was even sworn into office, all of which can mean that the U.S. economy, if anything, should be getting on a recession footing. If U.S. bonds are having trouble, the Fed might have to step up its buyer of last resort status. It has been shedding treasuries to soak up inflation since 2022 by more than $1.5 trillion for treasuries. It's also sold about $500 billion of mortgage-backed securities. And so we can see here's the H.4. If you want to look up the Federal Reserve's balance sheet, it's called the H.4.1, factors affecting reserve balances of depository institutions. And here it was back in 2022, where U.S. Treasury holdings in 2022, April, were $5.7 trillion. Well, now it's $4.2 trillion. The Fed has sold $1.5 trillion of treasuries as interest rates were rising. That's the way you get interest rates to rise, is you sell off bonds. Well, the Fed has a lot of firepower to sell off bonds. They also have a lot of firepower to buy bonds. Again, they went from 5.7 trillion of bonds held by the Federal Reserve. They sold 1.5 trillion, and now it's at 4.2 trillion in federal treasuries. And then the mortgage-backed securities, that went from 2.7 trillion in April of 2022 down to 2.2 trillion. So you see about a $500 billion decrease of mortgage-backed securities. That's going to drive up interest rates as well. So when the Fed is satisfied that inflation is done, collapsing, or that unemployment is rising, that, you don't have to worry about inflation anymore, they're going to start cutting interest rates and they're going to start buying treasuries. And then interest rates are going to fall. It's practically guaranteed. And just look at the chart. Certainly the federal funds rate is going to come down. And even if they don't start buying bonds, but I think they will buy bonds, particularly if right now treasuries, it could be that some countries are, like in Japan, people are selling yen and selling dollars and buying yen. In Europe, they're selling dollars and buying euros. And it could be they're selling treasuries and buying Japanese treasuries. It could be they're selling U.S. treasuries and buying German treasuries right now in those countries. So you can see domestic flights to safety. And so the Fed historically is the buyer of last resort. So if there's some trouble with treasury bonds, then you might see the Fed intervene and start buying bonds, particularly short-term bonds. So I would expect to see that the 2-year treasuries are going to probably fall faster than the 10-year treasuries if the Fed doesn't want to hold long-term paper. I think they tend to prefer to hold short-term paper, and then they can keep rolling it as necessary to support the U.S. dollar. It's what their job is. They have one job, is to stop inflation, but also to support the dollar and to be the buyer of last resort. If the Fed resumes bond buying, that will tell everyone a lot about the direction of prices, which is that they're going to go down or they're going to be flat. Inflation is going to slow down. As usual, keep an eye on jobs and also rising energy and food production. But this can mean mission accomplished in terms of killing inflation. And that is good news. This is Robert Romano, Executive Director with Americans for Limited Government and Americans for Limited Government Foundation. Hit that subscribe button, ring the bell for notifications, and have a good day. But first, I guess we can look at the chat here. I do thank you for tuning in today. Let's see here. We've got some chats. Let's see. George, hello. My name is so-and-so. I can't read that. I can't pronounce that. And it means master poster. Okay. Hi, George. Can I post here? Yeah, you can post here. You could probably try commenting on the video. Maybe you're just a bot. Again, inflation is certainly falling, and that it's embarrassing, I think, to President Trump's critics who want to say that tariffs are going to cause inflation. Tariffs are not causing inflation. Inflation is always a monetary phenomenon. It has to do with the supply of money and the level of production. Well, the supply of money is flat for 3 years, but production is way up. So you should expect prices to be falling. Again, this is Robert Romano, Executive Director with Americans for Limited Government and Americans for Limited Government Foundation. Hit that subscribe button, ring the bell for notifications, and have a good evening.